All right, so let's keep going. Uh, I really kind of like the way this slide starts off. It says up here at the top, it says the meaning and uses of cost. So not exactly a regular sentence there. But what we are doing in managerial accounting is, we're planning for what we want to achieve. When we were looking at financial accounting, we had a lot of scenarios where we would be given a certain amount of revenue and we would have some expenses, and we might have had to calculate cost of goods sold based on where our inventory started and all of that kind of stuff. But the cost that went into all of those things was basically given to us. We were given beginning inventory, we were given purchases, we were given ending inventory. So it says determine the cost of products, services, customers, and other items to managers. Customers do sometimes have a cost. We'll learn more about that in the next chapter. But it says here, notice what it says here about cost. It says cost is the amount of cash sacrificed for goods and services that bring a current or future benefit to the organization. Okay, fair enough. Now let's read this. It says, as costs are used up in the production of revenues, they are said to expire. Expired costs are called expenses. So these two words are not exactly the same thing. So I want to give you, an example of two things real quick that work very much in an opposite manner of each other. So the first I'm going to talk about is prepaid insurance. With prepaid insurance, our cost, our sacrifice of cash is up front. And then we basically have a prepaid asset on the balance sheet, which is then expensed as the coverage expires, that type of thing. So we have our cost up front, and then we have an expense recognition as that resource is used up. But I want you to think a moment about payroll. Well, payroll works completely differently. With payroll, remember, this is the accrual basis of accounting. We recognize the expense, the payroll expense, when incurred, and then later the cost is realized when we sacrifice cash to pay our employees. Okay, so we do want to make this distinction between cost and expenses. Very important one. When it comes to cost, we have two things that we need to do. We're going to accumulate costs and we're going to assign costs. And accumulating costs is by far the easier of the two. It says that accumulating costs is the way that costs are measured and recorded. So we generally have a pretty good idea of identifying, okay, this is a cost, because we are going to ultimately sacrifice cash for that cost. We might buy a building now and expense that over time. Or I gave you the payroll example, but it's pretty easy to say, okay, this is a cost. And so costs are very easy to accumulate. However, from there we have to assign those costs. In other words, why did we incur this cost? And I really like these two questions here. It says to support manufacturing, to support selling the product. Because what we're going to find out is that with manufacturing, this is an extremely important distinction. This is a selling and administrative expense down here, but cost that come into play to support the manufacturing process end up being product costs. So keep that in mind. We're going to get to all that, but just understand accumulating costs is fairly easy. As long as we have a valid bill, invoice, payroll summary, whatever it is that we have to make good on, that's easy. But assigning those costs gets a little bit trickier. And I want you to keep in mind that example of payroll that I gave you, because it can get a little bit tricky. We're going to talk a little bit about cost objects. It says here that a cost object is any item such as a product, customer, department, project, region or plant for which costs are measured and assigned. So we know that we have a cost that's ultimately going to be paid out in cash or a cash equivalent, but is that cost related to a product, a customer, a department, general operating expenses? It depends. I don't know. What's the cost? So it says here, when we are going to assign costs, this is a little bit more difficult. It says now costs can be assigned to cost objects in a number of ways. And how we're going to do this exactly depends. Certain things like labor that we're going to use to manufacture a product, or materials that are going to go into a product. These things are easy. There's no judgment in those situations. But we need to understand that not all costs are going to fit nice and neatly without some analysis. We're going to have to look at these things and determine, okay, is this a product cost? Is this a cost that we would incur even if we made no product, and so forth? Okay, so there's a lot of gray area here when it comes to assigning costs. So we're going to try to break this down a little bit and at least give ourselves a chance here. This slide talks about both direct and indirect costs, and it says direct costs are simply those that can be easily and accurately traced to a cost object. So when we are able to do this, we know that a cost is related to a specific cost object. We're going to call this a direct cost because it is easy to trace. It's basically common sense. However, and so let me just give you an example of a direct cost. I gave you one a moment ago. I said something about labor that is actually manufacturing a product. Say, for example, we're making bird houses, and maybe we have some individuals who are responsible for painting those bird houses. Well, we call that direct labor, and we're going to get into that a little bit later. That's pretty easy to assign, but what about the supervisor that's watching over all of those birdhouse painters? Okay, they're not actually making a product, but they are involved. Might be a little bit trickier, though, to take their salary and assign those costs. So with indirect costs, it says that basically it's the exact opposite. They're still costs, but they cannot be easily and accurately traced to a specific cost object. So we're going to allocate the cost. Allocation means that an indirect cost is assigned to a cost object by using a reasonable and convenient method. So that supervisor may not be direct labor, but we can say, you know what, this supervisor makes so much a year. He supervises so many employees. These employees make so many, paint so many birdhouses, and we can allocate the cost of his salary as a product cost. So direct cost indirect costs. This is a pretty nice little slide to look at when it comes to object costing. And basically, we say that direct costs, we use direct tracing to a cost object, whether it is a customer, we're performing a tax return, some type of a product. Now, these other types of costs here may or may not be product costs, but we might have territories. They've given us the example of a state, but we might have another territory, one of the surrounding states, the accounting department, the finance department, marketing. You get the picture, okay? So with direct costs, very, very simple. This cost goes to this customer, but indirect costs, we use allocation. So to give you an example, I used to prepare a lot of tax returns. Okay, so the cost of preparing a tax return, what you have to pay me to do it, is a direct cost. An example of an indirect cost, however, would be the printed tax return, the salary or wage of the secretarial staff that printed that tax return, etc. Those individuals, we're going to allocate their effort across all of the tax returns, if that makes any sense. Okay. All right, so this video is getting a little bit long, so let's go ahead and wrap this one up, and we'll pick up on the next slide after this.